I'd just like to say thank you all for joining because I know this topic is a little bit dry, but it's very important and the more exposure, the better. Um, so let's jump on in. So full disclaimer, this is a introductory session. This is just meant to enhance your understanding of a Schedule K-1. I'm not a tax expert. I'm not a tax specialist. I am a CPA, but my background has been in audit. I've always worked very closely with the tax teams and auditing the controls over taxes, but I'm not the tax preparer. Moreover, the IRS rules and guidance are constantly evolving and changing. What we include in the presentation today could be completely obsolete by next year, just based on whatever the IRS deems pertinent. If you are looking for tax strategy and advice, this presentation is not for that. So please consult your tax CPA or a professional for any tax strategy and advice. So let's start at the beginning. What is the purpose of a Schedule K-1? So you've identified a sponsor, they're syndicating for a deal to buy a property you're interested in, an estate you're interested in. So you invest $100,000, say, in this partnership to purchase this property. That real estate partnership is required to file an entity level tax return. That is Form 1065. These real estate partnerships are known as pass-through entities, meaning that all of the income, losses, deductions, credits pass through to the partners of that partnership. Whether you're a general partner, a limited partner, everything gets passed down to the partners. The Form 1065 includes the Schedule K-1s to report each and every partner's share of the partnership's income, deductions, credits, etc. So another disclaimer is the amount of loss that you claim on your tax return may be less than the amount reported on your K-1. It is you and your tax CPA's responsibility to consider and apply any applicable limitations. And just keep in mind that any losses that may not be allowed this year because of those limitations can be carried forward and deducted in later years, subject to the basis limit at that time. So who files a K-1? General partners, meaning the partners who are tasked with the management of the asset and entity. The limited partners, who are more likely than not you that are joining us today. Those are the passive partners. You invest capital, but then you more or less sit back and hope for this deal to be successful. We have LLCs that come in various number of forms. We have partnerships, single member LLCs, S corps, and then also estates and trusts file K-1. So now we're going to walk through the form Schedule K-1 and just the various parts of that schedule. But I'd like to just take a step back and kind of go through the timeline and what happens before you are issued this form. So if you joined us in Whitney's masterclass webinar last week, we actually went through what the finance team at PassiveInvesting.com does, what our tax processes look like, and what our timeline is in terms of issuing K-1s, and also what our expectations are of our partners and what our partners can expect of us. But any of you who are joining us today that are already investors of one of our assets here at PassiveInvesting.com, you probably received a notification from Andrew back in November saying, please log into your IMS portal. IMS is the system that we use to manage our investors as well as our investments, and verify the information included in the portal is correct. So that would be making sure there's no misspellings, that your address is up to date, that the tax ID associated with the investing entity or individual is accurate. And I know a lot of you logged in and did that because we had a lot of changes, a lot of feedback, and that was very helpful and constructive in getting our rosters up to date as of year end. So thank you. So that was in November, and then we'll start gathering any necessary formation docs or agreements that may be required for the tax CPAs to get all the background prior to preparing the returns. Yes, typically the gathering of all the the agreement formation docs happens in year one, but for example, if we're switching tax firms, all that information is necessary to be gathered and sent again for a new firm. So making sure we have everything to the tax CPA that's possible prior to year end, so that then when year end comes, we're just sending over the financial statements and then any updated rosters in the case of open funds or assets that we're still accepting new capital, or if we sent distributions towards the end of the year and needed to include that information on the rosters. And then once the tax team has all the information necessary to prepare the return, they will get started immediately, draft up the Form 1065, send it to us for review. We'll have some feedback and adjustments. We'll work with them to get that all pushed through, and then they'll issue the final drafts. And then at that point is when we upload all of your K-1s to our system, and then it disseminates that information to you. I'm sure all of you are very interested in what does our timeline look like this year. So we've already received multiple drafts of the returns, sent them back. We've already received some finals, and we will start posting the K-1s tomorrow, and we'll continue posting all the K-1s throughout the month of March. Okay, so that was a little bit of a timeline. And just as a reminder, March 15th is the deadline for partnerships. So we will be filing all of our returns on March 15th, but it does take some time to get all these K-1s, thousands of K-1s through to you. So just know that they will be trickling in through the duration of March. Okay, so back to the form. So step one, double check to make sure the date is correct. It typically will be the beginning of the year, ending of the year for the applicable year, but just start there. Next section, which is the section I have highlighted in the red box right now, is part one, the information about the partnership. This is important because you need to recognize and know the partnership name in this box. If you don't, reach out to the sponsor or the individual who sent you this K-1 immediately, because these K-1s, they are included in the filing of the Form 1065. So if you are not a partner in the partnership, the IRS is going to think you are and come after you for whatever income or whatever's included in the K-1. So I just drilled in so you could have a more zoomed in view of this section. So step one, verify you recognize the partnership. And then also you might know the investment by the property name, whereas the actual entity name is maybe some other, like for example, at passiveinvesting.com, we typically form our entities using some variation of the address in which the asset that we targeted exists. So while you might not recognize that entity name immediately, you can always check your PPM to verify that the entity name aligns with what you actually subscribed in. Okay, so that's step one, verify that you know the partnership. Next would be the part two, just the upper section is what we'll go through first. That's the information about the partner. So I can't stress this enough. It is the partner's responsibility to confirm the personal information reported in this section is correct. So I said we sent out a notification to all of our investors back in November to verify the information in our system is correct, but the data can change hands a lot of times between exporting it from our system to, we exported it into Excel, then we clean up the format to put it into the tax CPA's necessary format needed to update into their system. Then we send it off to the tax CPA, at which point they usually do some tweaking to further format the information. They verify the tax IDs are in the proper format. For example, we don't want to just see a long string of numbers. We need to know if it's an EIN denoted by the dash or a social security number denoted by the 2 dashes. So just request of our investors or future investors, make sure that information is correctly formatted in your subscription docs so that it can seamlessly get integrated into our system and exported cleanly. So, okay, then they go through the Excel file, clean it up a little bit more, then they import it into their tax software, at which point their tax software spits it out into this tax return. And then we send those K-1s to you from the tax return point. But there's a lot of different systems and changing of hands of data. So there's oftentimes for mistakes to occur, or for example, I've seen that some tax software doesn't properly identify updates to addresses. For example, you might change your address in year 2. It might miss that you did that. And so your K-1 will still generate your old address. Or in the case of you assigned your interest to your trust or LLC, it might miss that update. So it's always necessary not only to review your information on the front end, but also review your information immediately upon receiving your K-1. The earlier you identify an error, the better, or the more likely of an opportunity for your sponsor and your tax, or your sponsor and their tax CPA to make a correction. I will say at passiveinvesting.com, just because we have thousands of investors and a lot of syndications and funds, we are not likely to update any cosmetic changes. So if it's a spelling issue, or if it's an address, or maybe your social security number is right, but the name not including the joint name, we're going to say, please bring this to our attention and we will make that update in the subsequent year. Just because the process of amending or superseding a return might not be worth the correction, because your CPA can make that at your personal tax return level. So back to part 2, what are the most common issues we see? In box F, you would see potentially an incorrect name or address. So you might have invested through an LLC, but in our system, we had you included under your individual name, and we have your social security number associated with that investment. Again, that could have been prevented if you checked the system up front, or you asked to see the cap table, or checked in with the investor services team. And alternatively, it could have been different. You could have multiple investments with the sponsor. One you invested through an LLC, one you invested independently, but for some reason the system overrides both of your investments to be with the LLC, but you wanted it different. So that's just a nuance that can occur. Try to catch it as quickly as possible so that that change can be made. Another issue we've seen is for those investing through IRAs, the custodian name or the EIN for the custodian is missing. So if it's an IRA, you don't need to have your social security number on that. It should not be in your individual name. It should be sent to the custodian. Another area for improvement for all of us would be identifying the domestic and foreign partners. So sometimes we'll have partners who are domestic, but they only include a foreign address. And so our tax team could see this foreign address, assume it's a foreign partner. So it's really necessary for you as an investor to make sure it's clear who you are and which box should be checked in that circumstance. Another area, single member LLCs. So in the last few years, this has been a kind of evolving section of the K-1s, because you used to be able to just put your single member LLC and the EIN associated with this, but now the IRS has added this section H2 to show, okay, you invested through a single member LLC. From the IRS perspective, that is a disregarded entity. So we would put your EIN associated with that single member LLC and the name of that single member LLC in H2. And then in the upper section, so E and F, we would report who the ultimate beneficial owner of the single member LLC is. So typically, again, a single member LLC is a disregarded entity, so all of the income deductions, losses pass through to the beneficial owner. So typically that beneficial owner would be you as an individual, unless you've set up or structured this differently. So we'd have your social security number in E and your individual name in F, with your investing entity, the single member LLC, in H2. And then lastly, just something to keep in mind, if it is a retirement plan, make sure we're informed so that this box in I2 gets checked. Okay, the next section would be the still confined to part 2, but it's the partner's share of profit, loss, and capital. It's in the red box there. I'm going to zoom in. So this section is generally based on what is in the partnership agreement. So you would go to the section that says how much of the entity does the manager own. So you could calculate it by saying I invested 100,000 divided by the total equity times the percentage of the partnership that you're buying into to determine your profit and loss. Whereas capital is typically just your investment amount over total equity. These two numbers will typically be consistent year over year. The exceptions would be if we were continuing to accept capital throughout the year. So if people were continuing to invest, if it were an open fund or an open single asset that had not yet hit its fundraising goal, we would continue to accept capital, which would dilute your percentages. Or alternatively, if an investor redeemed their investment, that would also change your percentages. The next exception would be if you assigned your interest to another partner or to a new partner. However, that would typically only impact your K-1 and then the assignee's K-1. I've seen sometimes in year one, you'll see the beginning percentages are 0. Sometimes you'll see in a liquidating year, your ending percentages are 0. I think the proper IRS guidance is that after, like in year one, after you invest, your beginning percentages will reflect what those percentages are right after your investment is made. And then conversely, in the year that you liquidate, the IRS guidance says the ending percentages will actually reflect what the percentages were right before your liquidation. Again, it varies. Okay, next section we're going to talk through briefly would be this liabilities section, still in part 2. This is the partner's share of liabilities, and this is to report your individual share of the partnership's liabilities. Typically for these multifamily syndications, you'll primarily see non-recourse and qualified non-recourse financing, unless you are directly liable for the debt, then you might see something on the recourse line. More or less, you can glaze over this section as long as your capital balance is positive. It really becomes more applicable if you have a negative capital balance because then it's used to determine your basis. That's something that you should go over with your tax CPA or a professional, and the adjusted basis would be calculated using all 3 amounts or whatever amounts actually include the information. Okay, now we're going to discuss one of the most important sections on the Schedule K-1, that is the Partners Capital Account Analysis section, Section L. This, it's a critical section to understand, and not only just understand, but to track. So if you're going to take ownership of anything in the section besides your personal information, it would be this section. So let's just walk through what we're doing here and then why it's important. So in year one, the first year you receive the Schedule K-1 for the first year that you're invested, the beginning capital account balance, so the first row, will equal 0. Typically, it just will not have any numbers there indicating there was no beginning capital account balance. Then we'll add your capital contributed during the year, so that would be your investments made during the year. Then we would allocate the partner's share of the current year net income or loss. For these multifamily investments, that's typically a substantial loss in year one, which we'll get into later. And then we would back out any withdrawals and distributions. So any monthly, quarterly distributions paid out during the year, or if you were to redeem any capital, that would go in the withdrawals and distributions. So all that to calculate your ending capital account balance. So like I said, year one, you're typically going to see a significant loss. That's normal. The first few years, you'll see a hefty depreciation expense, and that's because we, at least at passiveinvesting.com, and most of the other sponsors will do this as well. We will order a cost seg study. and we'll maximize our depreciation in year one, and we will take full bonus depreciation in year one. And I know the bonus depreciation is sunsetting out through 2027, but at least this year you will still see a sizable depreciation expense. So what that's doing is it's taking your net income from your operations and it's backing out depreciation, and it'll calculate your loss. So it's not just to clarify, it's not a direct reflection of how the asset is operating. It's really just a tax loss to help generate this passive loss. So why is this important? You need to be tracking your losses, and your tax CPA should be tracking all of your losses on Form 8582. It's important because you need to keep a good record of these losses. For example, say you switch CPAs in the middle of the year and you had just entered 5 new deals and you had all of these losses, but your CPA didn't track it on Form 8582. You didn't track it, and you go to this new CPA and say, we sold 2 of these deals. You're not going to have those losses to offset the gains from those sales unless you're properly tracking and retaining this information, because more likely than not, you're always going to have some type of suspended loss or carry forward losses that you'll be able to use to offset income in the future years. That is why this section is so important. Next, we're going to go through some various boxes in part 3. So let's start with income. So typically you're going to see the multifamily rental income reported in box 2. It's generally passive income for all partners. There are exceptions, and that is if you are a real estate professional and you materially participated in the activity. So the real estate professional requires you to meet both of the following conditions, which is included in Section 469. You can look this all up on the IRS website. More than half of the personal services you performed in trades or businesses were performed in real property trades or businesses in which you materially participated. And you performed more than 750 hours of service in real property trades or businesses in which you materially participated. So again, most of you joining us today would see all of the rental real estate income or loss reported in box 2. It would generally be passive income to you unless you are a real estate professional. So that's going to alter where your tax CPA, or you're preparing your own personal return, will alter where you're recording that income on your personal return. You may see other types of income from operations, for example, outside the multifamily window, like for car washes, you would see a lot of the income from the car wash operations hit box 1 because there's not rental income or loss generated from those car washes. So how are we calculating that income? We are using Form 8825. It's attached to the Form 1065 to calculate that rental real estate income and the expenses to generate the income. So that's taking your gross rents and it's backing out all of the rental real estate expenses. And just want to highlight here that includes depreciation. So that will be the 100% bonus depreciation in 2022 which will really drive that number to a loss position. And it also includes interest from your loans. So taking gross rents, we're backing out all of those rental real estate expenses like advertising, travel, cleaning, maintenance, commissions, insurance, legal, and also backing out depreciation and interest. We then populate that amount in our Form 1065, and then that amount would be net against any other types of income or loss that we see coming through. Typically, you might see interest income is then pushed down to all of the partners. So the partners are taxed on the net income of the partnership regardless of whether or not that income was actually distributed to you. The next section in part 3 that I'd like to discuss is distributions. So in your partnership agreement, there's typically a section that discusses this. It's typically a preferred return on the capital invested by the partner. So that's typically a stated preferred return rate times the partner's unreturned capital balance. The form of the distribution, which you should be cognizant of when you're reading these partnership agreements, it will determine the tax treatment, and it can vary by the investment class. You might have class A, B, C. It's really, you just need to read the language in your partnership agreement to understand the nuances of the distribution. And then there's really two types of distributions that you will see for these multifamily syndications. It's either the current distribution, which will decrease your capital account balance. That's your return of capital, and you will not be taxed on those distributions as long as your capital account balance remains positive. And then you also have liquidating distributions, which are distributions to zero out your capital account and also zeros out your equity interest in the partnership. Lastly, I'd like to go over the other information section of part 3, just highlighting what we typically see from a Schedule K-1 from a multifamily investment. You'll typically see, and the IRS has a kind of cheat sheet that shows all these codes. So if you see on my screen right now, it has interest income that's denoted by code A. So under box 20, you would see a little code say A with your associated allocation of the interest income alongside. So we'll see interest income, we'll see the business interest expense as code N, which reports your share of the partnership's deductible business interest expense, and that's used to compute your basis limitation. You'll also see any qualified income business deductions denoted by code Z. Generally, you're allowed a deduction of up to 20% of your net QBI. Again, work with your CPA on this. They'll report the information on Form 8995, and typically will include any additional pertinent information in a footnote, section 199A footnote in the K-1. Next is the unrelated business taxable income. This is denoted by code V. This is typically used by any tax-exempt partners to determine any amount of income that may be subject to tax based on debt leverage. Again, all of these things you should consult with your CPA to understand the limitations on losses and your deductions. Just before we get into the reminders, going back to this part 3 section, typically the only other sections you might see used would be box 5 for interest income. So if there's excess cash sitting in the partnership that's being invested, all interest income would be allocated to this box. And then the gains, so like in the 9 and 10 boxes, would come into play upon the dissolution or the sale of the asset. That's where the gains would be captured. So now we're going to go back to the reminder section. Just something to note, at the very top right section of your Schedule K-1, there are 2 check boxes. One says Final K-1. That is to be used in the typically the year that you're redeeming or liquidating from the partnership, and it will be used to denote that this is your last and final K-1 issued to you for this partnership. Alternatively, or just the next box would be the amended K-1. So if we were to identify an adjustment necessary and the 1065 were amended and we issued new K-1s, that checkbox would be checked. Next is the Form K-2s and K-3s. So now included on the Schedule K-1 is box 16 that says Schedule K-3 is attached if checked. this is one of the areas that the IRS just can't figure out exactly what they want to do in terms of the requirements around the Schedule K3. I think they've already changed their mind 3 or 4 times this year related to the 2022 return, whether it's a required form or not. Conservatively, we're going to likely issue K3s with the majority of our K1s, which will increase the pages in your K1. However, if you're not a foreign investor and have no foreign activity, the K1 is not, the K3 is not applicable to you. So you can just ignore it. It's just required by the IRS to give them additional transparency into foreign activity. So yeah, you will likely see that box checked with a K3 attached. Some you will see a disclosure saying how there were no foreign investors, there was no foreign activity, and we may elect not to include the K3. Like I said before, the bonus depreciation rules are sunsetting through officially through 2026 with no bonus depreciation allowable in 2027. That just means this year you can take 100% of your bonus depreciation. Next year it's 80%. The following year it's 60% with some nuances. So still maximizing what we can while we can. And then something we really didn't touch on today would be the state K1s. We really just talked about the federal K1. Just want to put this out here to be aware of the state compliance pertaining to the K1 filing requirements, as well as the treatment of bonus depreciation. Some states make you add back bonus depreciation. Some, if you're investing in a fund, for example, that has assets across several states, you may receive K1s for all of those states. You need to know if you should be filing returns in each and every one of those states. And I know you'll probably ask me this in the Q&A. It's not a black or white answer. Every state has its own sets of rules and guidance. Sometimes if you have a loss, you don't have to file a return, but you want to maximize that bonus depreciation. So then you may have to file a state return. So it just varies by state, and it's depending on how many states you receive K1s for, it could potentially increase the fees associated with your return. So just make sure you're having these conversations with your tax CPA prior to investing in these partnerships, and also having a good conversation with your sponsors to understand what you can expect in order to just do this correctly. These are the tax return due dates. So partnerships and LLCs, the IRS due date is March 15th. You can elect to extend that. So the extended due date is September 15th. Same due dates for S Corps. And then your individual 1040s are due April 18th. Again, you can elect to extend that due date to October 16th. Your single member LLC, we talked about this before, but a reminder, your single member LLC is a pass-through entity, and all the income flows through to the ultimate beneficial owner, which is typically you as the individual. So those are due with your individual return on April 18th or extended to October 16th. And then C Corps follow that April 18th deadline as well. Okay, we are reaching the end of this presentation, and just a few summary reminders just to take away with you today. You verify your personal information is correctly stated in the partnership cap table and the investor records. That's what you can do before this whole tax process starts. Next, understand the timeline. Ask your sponsors, ask for updates, work with your own CPA so that you know if you need to extend your deadline or not. Once you receive your K1, confirm the information reported on your K1 is accurate. That's your personal information that we talked about in part 2. Use that K1, work with your tax CPA to report your income losses on your tax return. And then don't forget to keep track of your losses. So take that cap table that's in part 2 at the bottom left-hand side, put it in an Excel spreadsheet and track it. Keep track of your losses. It is no one's responsibility except for your own to make sure that you have a full, consolidated list of all of your losses to help you offset those gains that you will definitely receive in future years if you are invested. So carry those forward, utilize them to offset your income, use the forms properly, and have check-ins with your CPA to make sure they are capturing them and picking them up. Okay, so I'm going to end the slideshow and then take a look at the Q&A. Guess I'll put MFI Income on the screen. Okay. All right, so should Section J percentages all be identical? So here, let's go back and share my screen so we can all be in this together. Okay, so this Oliver's asking, should Section J percentages all be identical? This is Section J. It shows you your profit and loss percentages and your capital percentages. No, the answer is no. Typically, which this again, it could completely vary, but your profit and loss percentages will typically be less than your capital percentages because your profit and loss percentages include a manager's stake in the profit and loss, whereas your capital is just your equity invested over the total equity raised. And then just to expand upon that, Oliver, should they be identical each year? Again, typically they will be consistent year over year if it's a closed fund, but there are exceptions, and that being additional capital contributed or redemptions. So hope that helps you. Good question on the US syndication. Someone asked, can depreciation loss from a US syndication be used to offset Canadian income, or does one lose that benefit being a foreign investor? That is something to take up with your tax CPA. You would think that the losses would be able to offset each other, but there's always nuances. If my Wyoming LLC is a partnership with my wife, is it still considered a disregarded entity? So you need to understand the structure of that entity. Is it a partnership or is it a single member LLC? Because the way you phrase the question, if my Wyoming LLC is a partnership with my wife, that includes two members in the entity, that would indicate it's a partnership. I mean, unless you've structured this as a joint individual, you should talk to your tax CPA. The way you phrased it, it sounds like a partnership, but given that you could have it under one social security number, it could be rolling up to just one ultimate beneficial owner and could be structured as a single member LLC. See, everything has a caveat. Do I foresee that all K-1s are going to be delivered in March? At this time, I have no reason to believe that they won't all be delivered by the end of March. Again, we're going to start uploading them as soon as tomorrow, and then we'll continue uploading them throughout March. At this point, we are still on target to file everything by March 15th. Obviously, things could happen and problems could arise, but yes, all of our LPs should be receiving their K-1s by the end of March. Confused by the manager's stake. Are the manager profits distributed to the LPs as well? So are the manager profits distributed to the LPs as well? This is just in your partnership agreements. It'll say you are investing in 70% in the stake of 70% of this entity, and so the manager has the other 30%. So in your P&L percentages, the way that we're calculating this is 70% of that income or loss is allocated to the LPs, and then 30% would be allocated to the manager entity. Holly, I think you might be referring to maybe the GP related activity, which would not be included at the LP entity level. Okay, assume I invest into investment. One structures distributions as return of and the other as return on. Will both K1s show on and off distributions in box 19? They should both be included in box 19. It depends, like some syndications use dividends box. Some people use dividends and distributions interchangeably, although they are slightly different. So again, the key here, understand what the distributions are, whether they're on or of capital. And then the K-1 should indicate whether it's reducing your basis or not. And then it just depends. So sorry, it depends. Okay, bonus depreciation. If I invested in 2022, 100% shows up on K-1s for 2022, and then in 2023, 80% of value shows up on K-1. I don't know what you're asking. So in 2022, 100% of the bonus depreciation is allowable. In 2023, 80% of the bonus depreciation is allowable. So you will not see the full value because that will be performed at the partnership level to determine what the net income is to then allocate to the partners. Okay, so we've cleared all of the Q&As. Again, if you have any other questions, Talia will include an email address that you can send those to. I really appreciate everyone for joining us today. And I hope to see all of you at MFINCon in Charlotte this summer. And feel free to come up and say hello to me. I would love to meet every one of you in person.